All right, in an article in Investopedia, the title is, Who's Paying for All These Bank Failures? I'm going to help go through this article. We'll see, is it full context? Is there information that would be helpful? Because I find in reading a lot of this, they tell part of the story to make people feel comfortable, to appease their advertisers maybe. I'm not quite sure, but it says you may think that the taxpayers ultimately foot the bill, but that is not the case. Despite a buyout by J.P. Morgan, the collapse of First Republic Bank will cost the Federal Deposit Insurance Company approximately $13 billion, though neither taxpayers nor the government is footing that bill. Okay, so $13 billion. There's the basically premiums that all these banks pay to the FDIC, and then you have $250,000 in your account that's covered by the FDIC. But the FDIC, as of the end of 2020, had about $110 billion. So this one bank collapse is going to take 10% or more of what they have set aside from just this thing. So it says the key takeaways. The FDIC has spent roughly $23 billion on bank collapses in 2023 and is estimated to spend $13 billion more on First Republic, as we just said. That money comes from the agency's Deposit Insurance Fund, it's the DIF, which gets money from the FDIC-insured financial institutions and interest earned on government bonds. See, they have like a $2 billion cost to run the FDIC, so the rest of it is paying out all of these things when the banks have failed. It says, while taxpayers may not directly foot the bill, they may still feel the effects. So let's talk about that. First Republic is the third high-profile bank that has failed in the U.S. this year, and the second largest in the nation's history. The FDIC put the bank under receivership recently, sold its assets to J.P. Morgan, and took the liability hit. So, by the way, J.P. Morgan, pretty nice. They get to pick up the assets. Did they pay full price? Did they pay a discount? Well, if it's anything like 2008 and 2009, people got to buy at a deep, deep discount. All right, so the FDIC has covered the $23 billion for Silicon Valley Bank and Signature, and that was in March. The federal agency gets this money from the DIF, as I mentioned before, to resolve bank failures in an orderly manner, it says. Okay, so they're at $23 billion here, right? And then they've got $13 billion for this latest thing right here, right? The collapse of First Republic Bank. So with them covering that kind of stuff, and up to 50% of banks being insolvent, what is this really going to mean? Well, back to the article. It says the FDIC protects bank customers by insuring deposits, $250,000, if the bank goes into receivership, and divesting their assets. Deposits in excess of $250,000 are called uninsured deposits and aren't usually covered by the FDIC's insurance fund, although you just go to multiple banks. So if you have 500, put 250 in one, 250 in the other, and it's still FDIC. But does FDIC really have enough money to cover all this? See, it says the ultimate cost of bank takeovers and bailouts is covered by the DIF, which is depleted each time a bank is placed under receivership. So that's not entirely true, because the FDIC can actually go to the Treasury and get more money, because if we look back to the $5 trillion bill that happened back in 2009, essentially from that banking crisis, and here we are not that long later with regulation. Why isn't the regulation working is the question that I have. Well, part of it has to do with the Fed tinkering and printing money, then raising interest rates, and then all of a sudden the value of the bank's assets go down because raising interest rates, although the depositors now get higher interest rates, and the bank can charge a higher interest rate, it's not as good as when interest rates are low, because when interest rates are low, their assets are, maybe they're paying $1 for something they could charge $3 for. Now they have to pay $4 to get $100, and they can only charge $7. So yeah, that's $3, but the spread's not as good. Going from 1 to 3 is a 300% markup. Going from 4 to 7 isn't even 100% markup. So that's a little bit something to consider. So there's 4,700 banks registered with the FDIC, as the article talks about. But it says the second source of revenue is interest earned on U.S. government bonds, because yes, they have this money comes in and they get that interest. And it says in December 31st, the value of the DIF hit $128.2 billion just before this year's bank failures. Well, some of these banks are worth more than $128.2 billion by one bank alone. Now, it's not that all their assets become worthless and totally defunct unless there's some major amount of fraud. But as you can see in here, the FDIC Deposit Insurance Fund balance went negative in 2009 and 2010, and that's without even considering that there was $500 million that came in from TARP. And there was another $1.2 trillion that came in from other government resources. So this didn't have an adequate ability to handle all of what it's saying it's going to handle. It has to go into the taxpayer. So it says taxpayers not directly foot the bill, but they sure as hell did in 2008 and 2009. It may trickle down. For example, if a bank has to pay more for deposit insurance, it might charge you a higher interest rate on a loan or offer you a lower interest rate on your savings account. Thanks, the bank. You know, in March, after everything happened with Silicon Valley Bank and Signature Bank, the FDIC placed these institutions under receivership, and the FDIC made an exception for the two banks that allowed for depositors, even those deposits greater than $250,000. Why? Because it's Silicon Valley Bank. People had more than $250,000 of deposit. But, of course, everything would be just fine. Well, now it's going to be footed by FDIC, and when that taps out, by the taxpayer. So the cost of the FDIC would be roughly $20 billion for Silicon Valley and $2.5 billion for Signature Bank. The lion's share of those two banks' failed assets were eventually acquired by First Citizens and Flagstar Bank, by the way. The failure of the two big banks within a few days set off deep turmoil within the regional banking sector. I don't love regional banks personally. I mean, maybe they're friendly or maybe they're nice, but we see Morgan Stanley is going to survive this, right? Morgan Stanley Chase gets to acquire the banks. Wells Fargo, like the big banks have a lot more stability, as we saw in 2008. So yeah, that's basically what we're facing here with this article, is saying, hey, once this is tapped out, which has like $123 billion in FDIC, it's already from three banks. You know, here it's saying FDIC already covered $23 billion with just Silicon Valley and Signature Bank. Three banks. When there's more, that's when the federal government steps in, the taxpayer has to step in. And so this is why I'm not heavy into putting my money into the bank. I do enough to pay the bills, but the rest of mine goes into cash value life insurance. Yes, I even have a decent amount in Bitcoin, which is highly volatile and not for everybody, but I can move it a whole lot faster than when I have to do a wire with the bank. I'm not a huge fan of the central banking system, which is a closed system that we don't know what's going on. They're printing money. They're then taking money back. They're raising interest rates, and we're watching that just impact people's lives on a daily basis. They create inflation, then they try to combat it by raising interest rates. It's like letting the fox in the hen house and tell you how to watch all this happen. The Federal Reserve, I don't know. They're not federal. They're not a reserve. They're basically central bankers, which are private individuals. Yes, they have some an FDIC, a Federal Reserve chairman, and that is appointed by the government. But make no mistake, there's a lot going on here that they're not talking about, and they're at risk because they're already tapping into a bunch of the $128 billion that's in the FDIC from just three banks. And there's articles saying that more than half of these banks that are out there are insolvent in the United States. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.